In this channel, I speak a lot about index fund investing as a way to build wealth. However, the truth is that there are a lot of different ways to build wealth. Just like there's not only one way to climb a mountain, there are many different ways to win financially. So in today's video, we're going to delve into what I like to call climbing the investment ladder, where we can learn about all the different investment categories out there so we can add them to our portfolio in our climb towards wealth building. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Before we get started, let's first briefly talk about why we want to understand all the different pathways to building wealth. Isn't investing in stock market index funds enough? Yes, I love index funds. And I firmly believe that they're one of the best ways for individuals like you and I to build and grow our wealth. However, we have no idea what the future will bring. I mean, who could have imagined COVID-19 or Russia invading Ukraine? Therefore, risk mitigation is crucial to not only growing our wealth, but also protecting it. Therefore, one of the best ways to achieve good risk mitigation is to build and cultivate our financial wealth with a more diverse set of foundations. A good analogy I like to envision is to think of all these investment categories as legs on a table. 3 legs can keep a table steady, but having 4 legs is better, more stable. And how about 5? It can weather the toughest of storms. So as we go through these different investment categories, think of them as legs that you can add to your financial table to make it even more bulletproof. Alright, to start out with, the first investment category to grow your wealth is your 9-to-5 job. You might be thinking, what are you talking about, Tay? I thought you were going to talk about investments that was going to make me millions. Before you switch videos on me, hear me out a bit. Many of us might not initially see a 9-to-5 career as an investment. It is something we have to do in order to put food on the table and keep a roof over our head. But if you look at the data, a 9-to-5 job is still the most common way many people build wealth. In fact, the best chance that many Americans have of becoming a millionaire is through a professional degree. Think accounting, medicine, law, or engineering. According to Millionaire Next Door by Dr. Thomas Stanley, 80% of millionaires have a college degree. And of them, a lot of them hold advanced degrees. 18% have a master's degree, 8% have a law degree, 6% have medical degrees, and 6% have PhDs. In general, many millionaires in America are fairly well educated and in addition have followed the traditional education and career paths. This seems contrary to what we see on the media about millionaires, right? We think rebel college dropouts who started sensational companies. But the reality is that those type of millionaires are exceptions rather than the norm. And to crack our skewed perception a little more, a typical millionaire doesn't become one overnight. Most often, it takes a typical self-made millionaire decades to gain their wealth. This is why I believe the first investment category we want to master is a traditional career path, building our career capital to grow our income and thus our wealth. And this was true of me and my wife's pathway to wealth. Our biggest asset to growing our wealth wasn't investing in the stock market or real estate. It was our professional jobs from our professional degrees. In my case, an MBA, and for my wife, her nursing degree. These degrees provide us the income and the capital to climb the investment ladder. And even if you want to, let's say, start your own business eventually, being an employee first is actually the norm. According to Harvard Business Review, the average age of a successful startup founder is actually 45. And this is because a 45-year-old has things that a 22-year-old doesn't have. Number 1, experience, and number 2, money. Both that likely came from a traditional 9-to-5 career working for someone else. So before we feel like we want to quickly climb the ladder towards other investment categories, master this first. It will give you a solid foundation to enable you to be successful in the other categories. However, we don't want to stop at this phase of the ladder. When we rely only on our 9-to-5 job for our wealth and financial security, it is like trying to balance a table on top of one leg stool. It can keep the table up, but it's shaky. With one major event, it can easily topple over. So let's add another leg to our tabletop to mitigate the risk of it falling over. The second investment category to grow our wealth is stocks. And this is the one that I talk about the most in this channel, because outside of our careers, this is one of the most straightforward ways to additionally grow our wealth. But let's first go over some basics. Stocks simply represent an ownership interest in a corporation. When a company issues a stock, it's actually selling a small fraction of share of its business to each person who purchases a share of the stock. And these stock shares can be exchanged, meaning bought and sold on the stock exchange where the company is listed. The stock's value at any given time depends on how much another buyer is willing to pay for a share of that company's stock and how much the seller is willing to accept. For example, if the outlook for a company is good, buyers might be willing to pay more than you paid for your share of stock, and if you sold it at a higher price, you make a profit. On the other hand, if you had to sell at a time when the price of the stock was lower than you paid, you lose money. In general, it's most often not a good idea to invest all your money in just one company, since your entire portfolio's investment performance will be tied to the fortunes of that particular company. If the company experienced problems, the value of your stock would most likely fall, and you could possibly even lose your entire investment. Ever heard of Blockbusters, Enron, or Lehman Brothers? However, while buying individual stocks is quite risky, the stock market as a whole, in my perspective, is one of the greatest investments accessible to regular individuals like you and I. And the best way to tap into this money-making investment is to buy well-diversified, low-cost index funds. Here are a few specific funds that I like. Vanguard Total Stock Market Index Fund, also known as VTSAX. Vanguard S&P 500 Index Fund, also known as VFIAX. Fidelity 500 Index Fund, also known as FXAIX. They're also some of the biggest index funds in the world for a good reason. As you build your career and earn more money through your human capital, you want to start replacing your human capital with financial capital. Climb that investment ladder one rung up so your table is now more balanced with an additional leg to support it. Alright, but we don't want to just stop at stocks, because while they represent a great wealth building tool, at times they can be quite risky and therefore volatile. Third investment category we want to add to our table of wealth is bonds. Now I want to clarify that bonds aren't really a wealth growing tool. They're more like a wealth preservation tool. At a high level, a good way to think about bonds in comparison to stocks is to consider them as an investment that will smooth out our volatile stock investment ride. Stocks are a great wealth building tools for the long run. However, in the short run, they can be quite volatile, moving up and down constantly at the whim of the slightest threatening news. Bonds, on the other hand, might not have the big long-term returns, but it doesn't have all that volatility that comes with stocks. Let's talk briefly about what bonds are fundamentally. Bonds are essentially loans made from investors to borrowers to be paid back over a certain period of time. Many bonds require periodic payments, also known as coupons, to be paid to the investor over a term of the loan before the full principal balance is due at the end of the term. The annual coupon payments divided by the price of the bond is what we call yield. For example, if you bought a bond for $10,000 and it paid you $1,000 a year, it would have a 10% yield. And bonds, as I mentioned earlier, are very important to our wealth building ride because most often during market sell-offs, bonds are one of the few asset categories that hold its value. Actually, a lot of times it goes up in value. This is because when investors sell their riskier assets, they churn to buy bonds, commonly known as flight to safety. What having bonds in your portfolio will do for you is that during times of market crash, where your stock investments can dip by 20 to 30%, your bond investments will hold your portfolio steady. Now, if you're in your 20s and 30s and don't plan on dipping into your investments anytime soon, having the majority of your investment in stocks is a better move. You have time on your side to ride out the ups and downs of the stock market. However, if you're nearing retirement and you want to tap into your nest egg soon, you want bonds in your portfolio. You don't want to be caught in a situation where you need to pull money from the stock market when it's 20 to 30% down. And in my personal opinion, Vanguard Total Bond Market Index Fund, VBTLX, is one and only bond fund you need in your portfolio to help smooth out your investment ride. VBTLX is made up of over 10,000 individual bonds within this fund with varying credit ratings, issuers, and maturity dates. And this wide diversification of VBTLX makes it one of the best choices when it comes to investing in bonds because it minimizes all the risk that comes with holding individual bonds. Alright, now with most individuals like you and I, the three investment categories that we just discussed, our career, stocks, and bonds, are enough to provide us enough financial stability for the rest of our lives. However, as you build your wealth, you might feel like you want to add even more diversity to your portfolio. So let's talk about two more. The fourth investment category to grow your wealth is in real estate. And outside of stocks and bonds, real estate represents one of the most popular investment categories. Real estate is great because not only are you seeing cold hard cash income come in when you rent it out to tenants, you can even use it yourself. My wife and I personally own rental property out of state, and we often joke that if worse comes to worse in California, we can always move into our less costly rental property. Another major benefit to owning rental property, besides the rental income, is that if you manage your property correctly, you'll have other people helping you pay off the mortgage while you enjoy the long-term appreciation of the property. Additionally, if you borrowed money when purchasing the property, your return can be magnified due to leverage. Let's look at an example. Let's say you put down $50,000 for a $250,000 property. This means you borrowed $200,000 from the banks. Now, a year later, your property value appreciates by 20% to $300,000. Now, if you were to sell this property now, you would have made $50,000 profit from your $50,000 down payment investment. Essentially a 100% return. How long would it take to get a 100% return in the stock market? Definitely more than a year. Now, if this sounds too good to be true, don't worry, because it is. Debt, also known as leverage in this scenario, is a double-edged sword. It can help you gain a 100% return in this scenario, but it can also work against you if the value of the home price drops. For example, let's say the price of your home fell from $250,000 to $200,000 and you sold a house. Your initial down payment would essentially be gone because you still owe the bank $200,000. Another thing to note regarding owning real estate is that it requires a lot of hands-on activity compared to other investments like index funds. If you're managing your own property, you need to deal with tenants, list the property for future tenants, provide ongoing maintenance, and much more. However, if you're wise with your purchase, meaning you are not taking unnecessary risks, you have enough cash to ride the ups and downs of the economy, real estate can be a positive benefit to your overall financial portfolio. Another way to add real estate to your portfolio without the hassle of actually owning individual real estate properties is to purchase real estate investment trust, also known as a REIT. A REIT is a company that owns, operates, and finances income-generating real estate. But what we really need to know is that they're modeled after mutual funds. So buying a REIT is similar to buying index funds. Index funds allow us to buy publicly traded companies without buying individual stocks. Similarly, REITs allow us to tap into real estate investments without having to actually buy, manage, and finance any properties ourselves. Vanguard offers a solid REIT, the Vanguard Real Estate Index Fund, also known as VGSLX. It has an expense ratio of 0.12%. It represents close to 170 real estate companies that represent all different types of property investments in the real estate industry. Properties such as office buildings, hotels, and even residential properties. I wouldn't make this a core holding in your investment portfolio, but it's good to consider as an added diversity to your overall wealth. Alright, the fifth investment category to grow your wealth is in small business. This definitely isn't for everyone, but as you have more options in your life, it could be something to consider. And this could look very different for everyone, for there's a lot of different pathways you can take. You could start your own business outright, create a side hustle, franchise, or invest in someone else's small business. The world is your oyster when it comes to options in this category. And I say this could not be for everyone because owning and operating a business is not a small feat. A typical franchise operations manual, likely divided into many sub-manuals, are 300 to 500 pages in length. That's longer than my previous company's accounting manual. Imagine trying to not only digest all the details of trying to run a franchise, but actually managing $1 million operation. Hiring, training, managing, etc. The list of activities never ends for a business owner. However, with work comes reward, and owning and operating a small business can generate much higher returns than many other investment categories we talked about in this video. If things go well, your return on investments are most often not in double digits, but in triple digits. This is why owning and managing a small business can be tough, but also very rewarding. Alright, that's it guys. I hope this video provides you a framework of looking at your investments in a more holistic way. There's no one way to build wealth, but there are ones that make the best sense for you. Thank you guys for watching. If you'd like to learn more about wealth building habits, check out my video here. Until next time, all the best.